Welcome to onlineaccounting.lk, and we are going to do all the accounting standards relating to your A-level accounting paper today. So I'm going to cover up all the accounting standards which is mainly needed for the company account question, and also for the first paper there are some MCQs from these standards. So first of all, about myself, I am Hashan Waduge. I am a chartered accountant and also I am a degree holder from University of Sri Jayewardenepura, and I was a National IFRS winner, and also I represented Sri Lanka for the South Asian IFRS Championship. So in that we won the third place. Sri Lanka won the third place. Right. So you know I'm not doing A-level accounting lectures, right? So in the previous video also, I mean how to get a pass within a shorter period. I have summarized from all the areas where you are going to get questions, right? So I hope you all have watched that video and came to here. So I'm not conducting A-level lectures, make sure, but our onlineaccounting.lk is conducting, but that is not live classes, that is also video classes. So there is a lecturer who is conducting, and what onlineaccounting.lk does is we do lectures for AAT, right? Chartered accounting, CMA, ACCA, right? So if you are, after A-level exam, maybe you can join with us, but this is we are mainly doing for the benefit of A-level accounting standards, because we know they are struggling for these important areas. So I hope this will add some value to you, right? Now I told you I'm a chartered accountant, no? So where these accounting standards are being prepared? Who prepared accounting standards? So you know that is the Institute of Chartered Accountants of Sri Lanka. The Chartered Accountants Institute, Chartered Institute, CA Sri Lanka is preparing accounting standards. So I have the accounting standards book now, right? See, these are the two books. These are the two books. So you have one book called LKAS 1 to 41. LKAS 1 to 41. So you might be thinking, are there 41 standards? There are standards, but that is not relating to your A-level curriculum. So there is a SLFRS book also, that is SLFRS 1 to 16, right? 1 to 16, but for in your syllabus, that is even not going to be tested, but you will have only two SLFRSs, that is SLFRS 15 and 16. Now you can clearly see, right? See, who is preparing this? Who is preparing this? The Institute of Chartered Accountants of Sri Lanka, right? Institute of Chartered Accountants of Sri Lanka. So Chartered Institute is preparing, right? Chartered Institute is preparing accounting standards. So this is LKS 1 to LKS 41. So other book you are having SLFRS to SLFRS 16. So I will be showing you what are the standards you are having for your A-level examination. First I write, then I will come to book, right? So what are the accounting standards you are having, Lamai? You have LKS 1. LKS 1. I will be doing everything. Don't worry. Then you have LKS 2. LKS 2, right? The next one, LKS 7. What is LKS 2? That is inventories. What is LKS 7? That is statement of cash flows. Then you are having LKS 8. LKS 8. What is LKS 8? That is accounting policies, changes in accounting estimates and errors. Lama, I have done the same video in single medium also, but it is very easy for me to do in English medium. Why? Because even the accounting standard book also in English, right? So once you are done with A-level, even when you come into the professional life. So that is also very easy for you to learn. Right. So the next one, you have LKS 10. LKS 10, what is that? Events after the reporting period. Right. Events after the reporting period. Then you have LKS 16, the most important accounting standard in your curriculum, that is property, plant and equipment. Property, plant and equipment. Then you have LKS 37. LKS 37, right? What is that? That is provisions, contingent liabilities and contingent assets. So that is the end of LKSs. Then you have two SLFRSs. What are them? That is SLFRS 15, revenue from contract risk with customers. Then SLFRS 16, that is leases. So I will just show you, right? I will just show you from the book, okay? So from the book, see, LKS 1, you have LKS 1, presentation of financial statements, right? LKS 1, presentation of financial statements. Then LKS 2, you have inventories. Then LKS 7, statement of cash flows. So why LKS 3, 4 others are not there? Because those were demolished and there are some new standards. So then LKS 8, accounting policies, changes in accounting estimates and errors. Then LKS 10, you have events after the reporting period. LKS 12, you don't have in your syllabus, that you will be learning when you are starting chartered accounting or any other professional qualification. So then you have LKS 16, property, plant and equipment, and then you are having many, so nothing is there in your syllabus. So then you are having an accounting standard called LKS 37, provisions, contingent liabilities and contingent assets, right? Then next book, SLFRS, so this is a big one, right? This is a big one, okay? So this you have, see, SLFRS 15, right? SLFRS 15, revenue from contract with customers, and SLFRS 16, leases. So mainly these standards coming from IFRS, IFRS changed to SLFRS, IAS changed to LKS. So if you are, if you are learning chartered, you will be learning as LKSs and SLFRS. If you are learning like ACCA, so you will be learning the IFRS and IAS. So there is nothing different, right? Only just the word is different. But I hope so. If you want to recommend something, so definitely I would say you have to start with chartered. But if not, maybe you can go with another professional qualification, right? Lamai. Now, what I am going to do now? I will get one by one. I will get one by one, right? I will go with the most important to the least. Then I will explain. And before explaining this, for generally, right, for the general purpose, I will tell you something. What is that? Lamai, in all these accounting standards, right? So you know now accounting standards, which are LKSs and SLFRSs produced by Institute of Chartered Accountants of Sri Lanka, right? So I am also a member of this institute. So once you are done with all the exam and once you are done with the practical training, you will be getting the membership. So you are a chartered accountant, you are also part of this. In each of the standard they prepare, there is a common way, the common order that you can understand what the whole accounting standard is. Lamai, normally in this accounting standard, I will show you once I am going through, so then that will be easy for you to understand. Even for the single medium student, I didn't recommend to buy this book. If you need, even you can get that, but I hope that is, not necessary. So in each accounting standard, Lama, you are having 5 parts. 5 parts. What is that? First one, in each accounting standard, you are having something called definition. Definition. What is definition? Because in the accounting standards, Lamai, there are some jargons, some words which you cannot understand simply. Right? There are words like biological assets, property, plant, equipment, impairment, fair value, right? Scrap value. You have different number of, different words. So what they will do, they will put something called definition and they will explain. They will explain these words to you. So it's kind of a simplification of the jargon words to you. In each standard, this is there. Then, so this is like explaining, right? It's like explaining. Then, Lamai, each accounting standard starting with the recognition part. The recognition part. Each accounting standard starts with recognition part. What is recognition part? Recognizing means you identify, right? It's like you identify, right? You identify, you recognize someone, you identify. So this is basically when. What is that? When you identify an asset or a liability in your company, in your financial statements. So that is what it says in recognition. Then you have measurement. Then you have measurement. What is measurement? It's like measuring. So in simply I would say this is like how much. It's like for which value, right? Asset you recognize for which value. That is 100,000 or 50,000 or 1 million. What is the value? So this is basically that. And also this measurement, Lamai, divided into 2 parts. This measurement divided into 2 parts. What is that? That is initial measurement and subsequent measurement. Initial measurement and subsequent measurement. See, measurement we divide into 2. That is initial measurement and subsequent measurement. What is initial measurement? Initial measurement, the word itself says, at the initial phase, what is the value we need to recognize. At the initial stage, in which value we recognize this, right? The value at the initial, value at the initial phase, right? So what is subsequent? What is subsequent? Lamai, subsequent means what is the value in a subsequent period. In a subsequent period, right? That is the value in a subsequent period. So let's say you are getting an asset in the month of June, So you purchase an asset in the month of June. Your period will end on 31st March. So initial measurement will be happening in the month of June. When the subsequent measurement will happen? My subsequent measurement will happen in the month of March 31st. So whatever you do at the initial, the first day you purchase or you had the liability, that is the initial measurement. And whatever the measurement you do after the end of the period, that we call as the subsequent measurement. So basically all these are in the accounting standards. So the reason I'm telling you at the beginning, because when I'm going through this standard, so then it is very easy for me to explain this. Then the next one. Next one is, Lama, you recognize, no? Asset or liability, you recognize. So when you remove this, there is a time, there is a point where you need to remove these also from the books. That we called as what? From the accounting terms, that is derecognition. That is derecognition. So which means when we remove from our books, we recognize and we derecognize, right? Finally, so this is the final area, normally not in your syllabus as a like complex area, but for like LKAS 10 you have, what is that? That is disclosures. That is disclosures. What is my disclosures? Disclosures means we disclose to the others. So in the accounting standards, in each accounting standards, there are things that you need to disclose. Why? Why we prepare financial statements? That is to communicate to the interested parties like shareholders and others. We communicate. That's why we prepare financial statements. So when the shareholders read the financial statements, there are some specific explanations that we should have to provide in addition to the calculation, in addition to the figures. So those are the things we call as disclosures, right? So this is like additional explanations or hidden information, right? So basically this is like additional information. Okay, so that is what accounting standards comprised. So in each accounting standards you could see this, right? So now you should have a good idea on how to go through accounting standards. So even if you are coming to chartered, once you are done with A level, so you would be able to go through like this. So there are examinations, you can carry the book and go to the exam, read it, put the application. So you can follow this method, right? So now we are starting with the standards. First of all, we will be starting with LKAS 2 inventories. Right. So LKAS 2 inventories. LKAS 2 inventories. Right. Now, so first of all, that is always definition. Lama, what is inventories mean? Inventories mean, I will just read out what is in the standard, right? So what you can see, right? So see, you can see here, see, definitions. Definition in the 6th para, you are having the following are used in the 6th standard. Inventories are assets held for sale in the ordinary course of business. So I will read out, right? What is that? The definition. So inventory is divided as 3 parts. First one is that is held for sale. When I was doing the single video, I had to translate. For here, very easy. So held for sale in the ordinary course of business. Held for sale in the ordinary course of business. Second one, in the process of production for such sale. production for such sale. So which means I will explain. Last one, in the form of materials, or supplies to be consumed. So that is basically in the production process, right? What this means? Basically, inventory is divided into three parts. First one is inventories held for sale in the ordinary course of business. What are these? What are the inventories you are having in the course of business to sell to others? What we call for those? That is finished goods. So once you are done with production, you will be having inventories that is to be sold to others. That we called as finished goods. Next one, in the process of production for such sale. So still you haven't done the production. Still that is in the production. So it is in the work in progress. It is in the process. You see, it is in the work in progress. Right? So we called as WIP also. We called as. Next one, in the form of materials or supplies to be consumed. So that is as a material or a supply which is to be consumed in future. Right? So that we called as what? We called as raw materials. Right? So this is basically what is inventory means. So the definition done. So recognition is, always same for the assets. Recognition, asset means a past event which is having a present, the controllability of the economic benefit. So where that is done, you will recognize. So what is more important in inventory is the measurement. What is measurement? So this is basically my definition in the para 6, right? Definition in para 6. Paragraph 6. Okay. So then, what is the measurement? Measurement. Measurement, right? Okay, measurement. So measurement I will divide into two. That is first one, cost. Second one, net realizable value. Right? Cost and net realizable value. Lamai, make sure in our standard it says always you have to recognize the inventories, right? Cost or net realizable value, whichever is lower. So whether you are having cost, whether you are having net realizable value, you have to compare and see which is having the lowest. So if the cost is lower than net realizable value, definitely that is cost. But there are some situations where the net realizable value is lower than the cost. So in that case, you have to recognize the net realizable value. So how to measure the cost? What is this cost? What is the cost? The cost is divided into three. Cost is comprised with three components. What are they? Lamai. Cost comprised with three components. First one is the purchase cost, right? So this has everything. Cost of purchase. What are the cost of purchase? So cost of purchase means basically this is the price plus taxes. Taxes means what? Taxes means non-refundable. So if it is a VAT, so that is not, if it is a VAT and refundable, so that is not going to be included in the cost. And also the trade discounts, so you can add everything, right? So I will just read out what they are. Cost of purchase of inventories comprise the purchase price, import duties and other taxes, and transport, handling and other costs directly attributable to the acquisition of finished goods, right? So I hope, I assume that you are currently attending for any classes, A-level classes, maybe you are attending at onlineaccounting.lk for the video classes. So I hope from any of the class you have learned this, right? I hope you have learned this, because normally I know students are attending for your classes. So but my intention is to revise all the standards within a shorter period of time, right? Okay, so the next one, the second one, that is cost of conversion. Cost of conversion. Cost of, yes, conversion. What is conversion? Lama, you are having inventories as raw material. So when you convert the raw material into finished goods, there is a cost. You have to pay to the labor. You may have to have any additional charges. So you have to put that. So that also you have to add to the cost, right? Add to the cost. Then the next one, other cost. Those are the costs which we called as cost of inventories. To bring them to the current or present. Let's say present is good. To the present condition. So let's say maybe you have to do some cleaning up or something like that, right? So if you need to have any additional cost to bring inventories into the current situation, current location, right? So that is you include here, right? So cost of conversion means the converting, right? So from the selling point to the store point, that is basically this, and selling from that point to conversion, that is this, and from that also if you have any other additional cost, so that is this one. So all together we called as cost. Then what is net realizable value? Lamai, net realizable value is what the standard says. So everyone is telling what is the standard says, right? What is in the standard, that is prepared by Chartered Institute. So that is used by the A-level guidance book, that is taught by A-level lecturers, and that is also tested at the A-level accounting paper. So what the standard says, net realizable value, right? Net realizable value, NRV, is the estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated cost necessary to make the sale. So simply you can tell as this is the expected selling price. This is the expected selling price. This is the expected selling price minus the cost, estimated cost to sell. So let's say you are having an inventory that you can sell at 100 rupees. But to sell that inventory, you need to transport the inventory to Colombo, which will need another more 20 rupees to bring the inventory to that location. So which means your selling price is 100, your estimated cost is 20. So which means your net realizable value is how much? That is 80, right? That is 80. Lamai, so what the accounting standard says? What the accounting standard says? You have to always look at the cost and the net realizable value, and you have to see, okay, what is the lowest value? In that value, you need to recognize inventory, right? So when you can have a net realizable value lower than cost? When? Lamai, normally, if the inventories, if there are obsolete inventories, right? Right? The inventories which are obsolete items, so which you cannot use for the perfect condition, perfect productivity is not coming, right? Perfect productivity in inventory. So there are some obstacle inventories, right? Obsolete inventories. So in that case, there can be a NRV which is lower than the cost. And also, whenever the prices in the country is significantly going down. Now sometimes you may get something for a higher price, but because of the lower demand, the price is getting down. So once you move from the desktop to laptop, the desktop computer prices decrease. So in that case also NRV could go down, right? NRV could go down. And maybe there are some stocks that you cannot use for future, right? So like expired inventory, you get a yogurt, so yogurt will be expired after 2 days. So once 2 days done, so you cannot sell to the customers. So which means you are not getting the money. So net realizable value could be 0. So in that case, you have to written down the inventory. So that is the net realizable value, right? That is the net realizable value. So then, Lamai, to measure the inventory, there are two methods, right? So now we need to learn those two methods. So what are these two methods, Lamai? That is group by group basis, group by group method basis anything, right? Group by group basis or method, group by group basis and item by item basis. What is that? There are two methods, right? One is based on the group, other one is based on the item. So I will put you some examples, right? Put you some examples. This is the group. So some people tell us badge also. This is a group. This is the item. This is the cost. This is the NRV. What is NRV? NRV is net realizable value. So first one, so that is based on item by item. This is item by item. This is group by group. This is group by group, right? So I will put in the groups. What are the groups? That is, first one, soaps, right? Soap. First one soap. Second one shampoo. Right? Shampoo. Third one toothpaste. Toothpaste. Right? So I divide this into also 2. Right? This is, and this I divide into 2. What is that? So soap, there are 2 soaps, A and B. A and B. And shampoo there are, that is P and Q. And toothpaste X and Y. Soap divided into 2, shampoo divided into 2, toothpaste divided into 2. Right? So I am putting the cost and the net realizable value here. Cost, let's say 100, let's say 80, let's say 200, again 200, right? And 50 and 70. 50 and 70. Then net realizable value. Net realizable value, that is 90, 110, 110, then 220, then 150, 60 and 80. 150, 60 and 80. Right. Now Lamai, just see careful. First one is item by item basis. Item by item. What is that? In item by item, that is very easy. What we looking at, we compare each item. We compare each item and we see whether the cost or the net realizable value, whichever is lower, we identify that. We identify that. So see the first one. First one is under soap, the item is A. When you compare 190, what is lower? From the cost and NRV, what is lower? Lower is this. So that is the 91. This is 90. When you compare these two, cost is lower. So you put that, that is 80. When you compare this, what is lower? This is lower, that is 200. When you compare these two, that is 150. When you compare these two, that is 50. When you compare these two, that is 70. Now, this is how you calculate from the item by item basis. So then finally, the total value you put here. So total value, that is around 670, right? I hope that is around 670. So that is the value you have to recognize. But when you are coming to this one, group by group basis, just see carefully. Group by group basis, Lamai, we don't compare items, but we compare the total cost of the group with the total NRV of the group. What's that? Previously, we compare each item cost and NRV. Each item cost and NRV. But when it's come for the group by group, you only compare the group cost and the group NRV. So what is the group cost here? 180, this is 180. What is the group NRV here? This is 90, this is 110. So this is 180, this is 200. What is lower? Lower is this. So that is 180. That is 180. Right? Next one, shampoo. Previously we compared only P and Q, but now we compare shampoo, cost and NRV. So here shampoo, cost 200, this is also 200, so that is 400. NRV is how much? 220 plus 150, that is 370. 320, so 370, so this is 400. What is lower? Cost or NRV of that shampoo group, that is NRV how much? That is 370. That is 370. Last one, toothpaste. This is 50, this is 70, so which means total cost is 120. NRV, this is 60, this is 80, this is 140. So 140 and 120, which is lower? 121 is lower. 121 is lower. Now see the total cost. This is around 640, right? 640, right? 8. Sorry, this is 670, right? Yeah, this is 670, this is 640, right? This is 670, this is 640. Okay? Right. Yes, yes. This is 640, this is 670. So see, at the exam, Lamai, examiner give you whatever. Examiner can directly tell you cost and NRV is this much, or they may tell you cost so group by group basis, item by item basis, to evaluate like that also. So make sure whenever the way that examiner is presenting the information, you should have to have the knowledge to understand and do the adjustment or answer for the MCQ question. So this is the end of LKAS 2. End of LKAS 2. So we have completed LKAS 2. So next we are going to go for the most important standard of your syllabus, that is LKAS 16. So now my next one is LKAS 16. LKAS 16. Property, plant and equipment. Equipment, right? Not months, it's equipment, right? So in LKAS 16 also, so there is a definition. I will just explain that, right? So LKAS 16, there is a definition. Lamai, now having this standard book, it's not easy to read, right? So you should have to understand the way of reading. But so for this moment, no need to look at this. So maybe after that, after A level, you may try, right? So in LKAS 16, property, plant, equipments have been defined as tangible assets, right? Tangible assets. What is that? Tangible items. Tangible assets. Tangible means you can touch, you can see, right? So tangible assets, which is using to produce goods or services, and rent to others, and here what rent to others means, Lamai? Other than land and building, because that is being differentiated with another standard called investment properties, but that is not in your syllabus. So make sure rent to others means that is land and building. That is land and building. Other than the land and building, if you are renting, let's say motor vehicle you are renting, that is also property, plant, equipment. Rent to others, and which is are expected to use more than one accounting period, more than one period, right? More than one period. Okay. So here recognition will happen when? Here my recognition will happen in way If what happened, the recognition will happen. Recognition, right, will happen if you get future economic benefits and if you can measure the cost reliably, right? So I hope you know these two criteria always. Then the most important part, the measurement part, right? Measurement part. We are coming to the measurement. We are coming to the measurement. So measurement I divide into two, right? I divide into two, that is initial measurement. That is initial measurement. That is initial measurement and subsequent measurement, right? So that is initial and subsequent. Initial measurement and subsequent measurement. Okay. Initial measurement and subsequent measurement. Initial measurement and subsequent measurement, right? So initially measured, this is in the para 15th and subsequent measurement in the para 29th, right? In the standard book, that is in the para 29, right? Initially, we measure the property, plant and equipment at visual ulamai. We measure, that is at cost. We measure property, plant, equipment initially at cost. So cost should have what? Cost same like inventory. Cost will have what? Cost will have what? That will have purchase cost, right? So in the accounting standard, element of cost given, that is purchase cost plus non-refundable taxes, right? Then and trade discount. So same like the inventory one, right? Same like inventory. So inventory also same, no? So trade discounts also you minus. So that is the cost, first one. Second one, that is any cost directly attributable, right, to bring in the asset to the location necessary to operate the asset, right, or to use the asset. Final one, that is the estimated cost of dismantling, which means once you are done with the task from the asset, so now you are not going to use that. So in future, let's say after 5 years, you are going to remove the assets. So once you are removing the assets, you will be having an expense, having a cost in future, and the present value of that cost also should be added, but this is not normally being tested at the level. I mean, just better if you just know there is a expense like that. So if there is a theory question, you may answer. So that is the initial measurement. So make sure initially you recognize the asset at cost, right? Cost means, so let's say purchase price is 1 million. So to bring the asset to the current location, it is like 200,000. So let's say no dismantling. So which means this is being recognized at cost of 1.2 million. Subsequent measurement. Lamai, in subsequent measurement, you have two ways. So which means it is your responsibility to decide which method you are going to follow. So you have two methods. You can what? You can select either of these method. What is that? First one, that is the cost model. That is cost model. That is same like that. Next one is revaluation. Revaluation model. Revaluation model. Cost model or revaluation model. Lamai, what is cost model means? Cost model means, in cost model, you get the cost of the asset. So this is the initial cost. From that, you know this, you minus accumulated depreciation. You get the cost, from the cost you minus accumulated depreciation. Right? Then, so the next one is not in your syllabus, but I will write, that is accumulated impairment loss. Impairment loss. So you deduct everything and then you are getting a value. So this is according to the cost model. That value we called as what? We called as carrying value. Right? Carrying value. Written down value, carrying value. Right? So make sure, if you purchase an asset now, you have to recognize under this. But in future, once the period done, after 1 year, 2 years, you have to recognize subsequently. So either you could go with cost model or the revaluation model. So if you go with cost model, get the cost, whatever the depreciation up to that you recognize, whatever the impairment up to that recognize, and get the carrying value. Right? Then next one is the revaluation model. So in revaluation model, you recognize to which value? That is the revalued value. Revalued value. Right? So let's say you are having a building, you revalue to 1 million. So that 1 million would be the value, the price. You will be recording the building in the subsequent measurement. And make sure, Lamai, there is a special criteria that if you revalue, if revaluation happens, all items in the same category should be revalued. If revaluation happens, all items in the same category should be revalued. So if it is building, you have to revalue all buildings. If it is lands, you have to revalue all lands. Right? So that is the measurement part. Then there is a part that always students are mixing up. What is that? That is the revaluation. How to recognize the revaluation? How to recognize the revaluation gain or loss? And if last year loss, this year gain, what is that? So that is, mainly students are having the doubts on the revaluation. So I hope measurement you understood, initially and subsequent, how to recognize you understood. So next one is asset revaluation, right? So basically this is PPE revaluation. Okay. So this is in the para 31 of the standard book. Lamai, I will divide this into two. Revaluation I divide into two. What are these? What are these? First one, if it is a revaluation gain, if it is a revaluation gain, Lamai, what is revaluation gain? Revaluation gain means revalued amount higher than the carrying value, right? Revaluation value, revalued amount higher than the carrying value. So which means, what is the revalued amount? So let's say revalued amount is 100,000. If the carrying value is 80,000, so which means there is a revaluation gain. So when you have a revaluation loss, so this is basically, this is covering in the para 39. So next, revaluation loss. Next one is the revaluation loss. This is in para 40. When you can have a revaluation loss, so that is the other way around. If the revalued amount is less than the carrying value, if the revalued amount less than the carrying value, so that is a revaluation loss, right? Now let me make sure you can join to the Telegram group, right, which is mentioned in the caption. So you can join. So if there are any other videos, so if we are doing, so then we will be notifying through that, right? So that is very useful for you to join to that group as well, right? So revaluation loss, revaluation gain. And Lamai, revaluation gain, if the revaluation gain happen or if the loss happen, you have to see two things. That is what? If there was a revaluation done previously or revaluation not done previously, right? So if a revaluation happened previously, you have to recognize in a different way. If revaluation not happened previously, you have to recognize in a different way. How to do that? So first I will divide again this to 2. I will divide this again into 2. Again into 2. Right? That is first one. Previously revaluation done, right, and previously revaluation not done, or let's say first time revaluation. This is the first time you revalue. This one also I divide into 2, like same. So previously revaluation done, or we'll say as first time revaluation, or maybe same thing. First time revaluation. So which means now you know that revaluation happened. But if that is happened, if that is just a gain or loss, you cannot recognize. What you need to look at? You need to look at whether that is previously also revalued or not. So if the previously revaluation happened, Then you have to looking at again two things. What are them? What are these? That is, if previous revaluation gain. So if previous revaluation done, yes, and if there is a previously revaluation gain, have you recognized a gain? If not, the other one is previous revaluation loss. Previous revaluation loss, right? If it is a previous revaluation gain or a previous revaluation loss, right? So if it is a previous revaluation gain, then how to recognize? Then how to recognize? If it is a previous revaluation gain, Lamai, and this time also gain, so no problem, no problem. Why? Because last time also gain, this time also gain. So if it is a last time gain and this time gain, the same entry should be put. What is that? That is, you have to debit the PPE debit, right? Revaluation reserve credit. So once you revaluation reserve, when you credit means what? You put what? You put record in other comprehensive income, OCI. We normally call as OCI. So when you work in a company, so normally they call as OCI. If previously also gain, this time also gain, so how to record? PPE debit, revaluation reserve credit. So revaluation reserve credit means, Ramai, you have to put that in the OCI also. Other comprehensive income, you have to put as a revaluation gain. So make sure that. Next one. This time revaluation gain, but last time it was a revaluation loss. Now see. Lamai, last time when you had a loss, what you had done? When you had a loss last time, okay, we'll come to this then. First time revaluation loss happened, what is you are doing? You decrease the asset. So you charge to where? Lamai, you charge not to the revaluation reserve, but you charge that to the P&L. Because previously it was a loss. Now, previously loss, this time again, what you are going to do? Previously, you put that into the profit or loss. So what you have to do? First of all, you have to cut off that portion from the profit or loss. So you will credit that to profit or loss. Just take example. Last time, revaluation loss is 100. This time, revaluation gain is 150. So what you will do? Lamai, last time loss you put into P&L. So this time also from 150, 100 you have to put into the P&L in the other side. So last time you put in debit, now you have to put in credit. So then there is a remaining of 50 that should be recognized where? That should be recognized to the revaluation reserve. Okay. So if this is lower than 100, so then anyway that should be put into the profit or loss. So how to have the double entry? What is the double entry then? Double entry, so anyway PP will debit. But what is being credited? That is, first of all P&L from the value. Last time you recognize as a loss. Then revaluation reserve. revaluation reserve the rest of that. So if that is 150, last time 100 num, right? What happened? 100 credit, 50 credit, 150 debit, right? Hope already understood. What means just hilav karanawa wage. Last time if you had a loss of this, first you are crediting that part, then whatever the remaining part you will be charging to the revaluation reserve. Okay. Then, so there are no previously revaluation done. It's first time just what? Just a gain. So how to recognize? Very easy. That is very easy. Same like this, Lamai. Same like this. PPE debit, then revaluation reserve credit. So this is recording. This is also recording OCI, right? Done. Now revaluation gain part done. So we know if revaluation gain happened for the first time, you know how to record. If it is not the first time but previously gain, you know how to record. And if it was a previously loss, you know how to record. Then the next one is a revaluation loss. Lamai, last time loss and previously also revaluation done. Then same like here, what you have to look at, whether you have previous revaluation gain or not. If it is a previous revaluation gain, if you have a previous revaluation gain or a previous revaluation loss, previously revaluation loss, how to record? Lamai, this is the other way of the last entry. Previously you had a gain. So what was your double entry? PPE debit, revaluation reserve credit. Now what you have to do? Whatever the loss part, now you have to remove from the revaluation. Example, last time revaluation gain is 100, this time revaluation loss is 150. So what you will do? There are 100 in the revaluation reserve. So you first minus 100 from this, the rest of the 50 you will be charged to where? Charged to profit or loss, right? Same like the other way of this. So normally when you have a revaluation loss, PP will be credit, right? So what you are doing? Revaluation reserve, you had a credit balance. So from that balance you debit, and if you are having more than that, right? If you are having less than that, no problem. If you are having more than that, the other part should be debited to P&L, not to OCI, Lamai, right? This is not to OCI. What you are putting to OCI is only the revaluation reserve part. Whatever the changes in the revaluation reserve, you have to put into the OCI, right? If there is a change in the revaluation reserve, that should be put into the OCI, right? So then PPE credit. So then record revaluation reserve part in OCI, right? Not this part. Then previously also revaluation loss, this time also loss. Very easy. That is P&L debit PPE credit. Very easy. And first time revaluation, if it is a first time revaluation, then that is also same thing. P&L debit, PPE credit, right? Same thing, because if it is a last time loss, this time loss, same. If it is a first time revaluation and if it is a loss, that is also same. So make sure when they are a loss, you always put that into the P&L, right? When you are having a gain, you will put into the revaluation reserve. But when there are previously gain and losses, you have to see that per set off whatever the amount that is in the P&L or revaluation reserve, then the rest you have to put in the related account, right? So that is how you have to record the asset revaluation, basically the PPE revaluation in accounts. So next one is asset depreciation. Assets depreciation. So basically this is PP, right? This is PP. So this is in the 43rd para of the standard. Lamai. In depreciation, you have to just look at three things. That is if the asset is purchased, if the asset purchase in the period, if that asset purchase in the period, or the next one is if that is available from the beginning of the period to end. So which means those are the assets which you haven't purchased or not disposed, right? So others are the assets disposed. Disposed means either sold, right? Either obsolete. Asset disposed during the period. Disposed during the period, right? Whether the asset is purchased in the period, available from the beginning to the beginning of the period to end, or asset disposed during the period. Lamai, if this is purchase means you have to depreciate for how many months? You have to depreciate the asset, depreciate from the purchase date to, from the purchase date to period ending date, right? Depreciate from the purchase date to period ending date. Next one. If the assets available from the beginning of the period to end, so which means no purchase, no dispose. So which means what is happening? Depreciate. You have to depreciate the asset for whole year. Like let's say 12 months, right? If not purchase or if not dispose, just depreciate for 12 months. And the next one, if the asset disposed during the period, so that is disposed, not a purchase, not available from the beginning to period, but available at the beginning, but disposed. So what is happening? You have to depreciate from beginning to dispose date. So when you dispose, you have to depreciate to that. So let's say as an example, you purchase the asset on 1st January where the accounting period will be ending on 31st March. So 1st January, February, March, you depreciate only for 3 months. For this, you depreciate for 12 months. Let's say you are selling an asset in the month of December 31st, right? So December 31st. Your accounting period start on April. So April, May, June, July, August, September, October, November, December. You depreciate that to 9 months. So that is how you have to do the depreciation, right? So the next one, right? Next one, and the final part of the LKAS 16, that is the asset derecognition, PPE derecognition, right? And before going for that, Lamai, now you might be thinking whether you are having enough time for the exam. No, I will just give you a small example. Now, after doing it A-levels, you will be coming to the professional courses, no? Because without professional courses in the commerce field, you cannot go to the top, right? I mean, degree, okay, but you should have to have a professional qualification, that is mandatory. Now, just think, you are learning A-levels for like 2 years, no? Professional exams you are having for like 6 months. Lamai, we had a student who won the island first, right? Island first of the chartered second level. So we are doing chartered, AAT, CMA, ACCA, we are doing classes, right? So I am giving the example from the chartered. So there was a student who studied for chartered second level within a month. Within a month, she didn't do anything before that. She started doing studies before just 1 month to the exam. So if she could do, why you cannot do the A-levels? A-level is not that much difficult compared to the chartered second level, right? So A-level is easier than the professional exams. So professional exam not that much difficult, but little bit difficult. So if she can do within a 1 month, why you cannot? You just see this video. Watch this video on her and see how she achieved, what was her plan and her determination, right? So this is, she is elder than you, akka for you, right? So just see and get an understanding. If you also have a plan, I hope you also can get through the exam.
Hi, I'm Dinali Jayasinghe. I was able to be the island first in June 2021 Business Level 2 examination. I didn't work until May 2021, even though I had the exam in June 2021. So I put a WhatsApp message to the online accounting LK regarding some other matter, technical matter. But there, Hashan sir has noted me and he called me and asked me whether I'm doing all 4 subjects. Then I explained, sir, that I didn't do any work until now, but I have exams in June 2021, but I have all 4 subjects. I haven't worked until now and I might not be able to. But Hashan sir told me that you can do, and he motivated me and he gave me a plan. And I was able to come up with my own plan on how to do the exam. So I only had 25 or 28 days left for the BL5 exam and then BL7 exam. And in between that, I had about 3 weeks for the BL6 and BL8 exams. So there I came up with a plan, and even Hashan sir told me that I could watch the videos with into 2 speed. So I didn't refer the notes or anything. What I did was, I watched all the videos, watched everything, and during that I noted down all of the notes. Whatever I needed, I noted them down and I referred them, and parallelly I did my studies. So when there was only like 5 or like a week left for the exam, I started doing the mock exam. So the best thing about the online accounting LK is like they cover the syllabus on time and they put so many mock exams. So sir pushed me like do exams on time, complete watching videos on time. So I did all of that. I followed his whatever he gave, whatever the advices he gave me, I followed all of them, and then I started doing the mock exams. I mean, the students now are very competitive. Students now are doing part-time jobs, they are doing degrees, they are following courses. So the time they have is very limited. So you don't have to waste time on transportation. You can watch any videos any number of times at any time that you want, and that's one of the best things. So please choose the best path. I recommend onlineaccounting.lk, and I take this opportunity to thank Hashan sir and all the other lecturers of Online Accounting LK. Thank you for making me able to achieve the first merit in prize of Business Level 2 examination.
Now, I hope you watched the video. Now just determine, doesn't matter how many months you are having, because I don't know how many months you are having at the time you are watching this video. Maybe you are not a student who is doing this time A-levels, but next time. So maybe you are having more than 1 year. But that doesn't matter. What matters is whether you have a clear plan. You can get the lessons, you can put ticks whether you know this, right? So just to have a good plan, that will be very much effective for you. So then allocate the time, go through the lessons, go through the questions, get ready for the exam. So we are going with the next one, that is asset derecognition, right? PPE derecognition, I would say. So this is basically disposals, right? Disposals. Lamai. Always make sure when you dispose assets, you can have a gain no loss. Always you can have a gain no loss. So gain or loss from disposal. Gain or loss from disposal. This is in the para 71. Gain or loss from disposal equals to sales proceed you received from selling the asset and minus carrying value of the asset, right? Sales proceed minus carrying value of the asset, that is equal to the gain or loss from disposal. Lamai, when you can have a derecognition or a disposal, you may sell the asset. That is the first one, right? Whether you exchange the asset, you may exchange, right? Whether not able to use, right? So many things can happen. So if either one of these happen, it is a derecognition. So what you have to look at, whether you are getting something. If you are not getting something, the total carrying value is the loss, right? Then I will explain this with the ledger accounts, right? I will put 4 accounts, that is asset disposable account, right? Asset dispose account, then asset account. Asset account means basically the PPE account, right? I will put PPE. PP account, right? So then you have accumulated depreciation account, next you are having depreciation account. Next you have depreciation account, right? So I just put the double entries here. Lamai. Always make sure this asset dispose account is a temporary account. So this is only being created when you are disposing an asset, right? So what is happening? You know, in your accumulated depreciation account, you are having a balance brought forward amount. You are having a balance brought forward amount. And in PP also you are having a balance brought forward amount. What is happening? Whenever you dispose the asset, Lamai, you need to transfer both the cost and both the accumulated depreciation into this temporary account. Why? Because then only you can calculate the profit or loss, right? So what you have to do is first transfer this to asset dispose account, right? Disposable, you can tell anything. So then here this is PPE, then change to here, and here again asset dispose account, and that is, sorry, this is this way, that is credit, this is debit, right? So this is debit, this is credit. Accumulated depreciation, this is credit, right? So make sure what you have done, you transfer the balance to this account. So let's say if you are disposing one, and if you have more of the accumulated depreciation, for let's say you are having 5 vehicles, you are disposing one, so only you transfer that accumulated depreciation to this, right? So if you have 5 motor vehicles, if you are disposing one, then transfer the cost of that one to this. Then Lamai, also you may have a current year depreciation. So how to account that? Depreciation account debit, accumulated depreciation account credit. So maybe you are doing this first before transferring this. So whatever the current year depreciation, also you have to put in the accumulated depreciation, make sure. Then the total related to that asset, you need to transfer to the asset disposal account. Okay. Then if you sell this, what is happening? You will receive cash. So what you will do? You put the cash here. Then there is a profit or loss. Let's say just ignore that you are selling this. If it is a exchange, what is happening, Lamai? If it is a sale, that is cash debit, asset disposed account credit. If it is a exchange, that is PP account debit, asset disposed account credit, right? This is, so PP again, this is the value, is the fair value of the asset, exchange. So let's say you are giving a asset value of 500,000, you are getting asset value of 400,000, so you put here 400,000. Maybe it could be like, let's say some fire happened, so you are getting the insurance claim. So in that case, you may put the insurance here. All these are not coming at once, but I am telling the different scenarios, right? So then, Lamai, once you have the finalize the account. So there could be a difference. That difference, if it is a debit one, that is gain from disposal, and if it is a credit, that is loss from disposal. So if it is a gain from disposal, you put that into the income statement. If it is a loss from disposal, you debit that into the income statement, right? So make sure when you have a disposal, you have to do like that. And also, Lama, if you are disposing an asset which you are having a revaluation reserve, what to do? Now you are having a revaluation reserve. So once you dispose, are you going to maintain the same revaluation reserve account? No. So what to do? If you are disposing an asset which you are having a revaluation reserve, make sure you have to transfer the revaluation reserve. So revaluation reserve debit, and you are crediting that to where? You are crediting that to the retained earnings. You are crediting that to retained earnings. Make sure revaluation reserve you remove, and that part you put into the retained earnings. That is when you dispose an asset when you are having a revaluation reserve. So the revaluation gain in the revaluation reserve account, right? So this is all about the LKAS 16. So we have discussed the measurement, right? The revaluation, depreciation, and derecognition. So make sure in the company accounts question you can have a disposal, right? Also a purchase, depreciation, maybe exchange. But make sure if you know the standard, if you know the theory part, it is just about applying that into the question. So I hope LKAS 16 you have already understood. So we are done with LKAS 16. Okay, Lamai, so we are going for the next one, that is SLFRS 15, revenue from contracts with customers. Revenue from contract with customers, right? So, Lamai, this is actually the revenue standard. Previously, revenue standard was LKAS 18, right? And due to this new standard, this was changed to SLFRS 50, right? SLFRS 50. Now, basically in this SLFRS 15 standard, you have to recognize 5 steps. We call that as 5-step model, right? We call that as 5-step model. 5-step model, right? So, here I will be doing the whole 5-step model through this board, and then after that you will be able to tackle any question from SLFRS 15. Lamai, what are these 5 steps? First one, identifying the contract. First one is identifying the contract. Identifying the contract. First one is identifying the contract. Then the second one. Second one is identifying the performance obligations. First one is identifying the contract. second one is identifying the performance obligations. Third one is what? Determining the transaction price. Third one is determining the transaction price. Third one is determining the transaction price. What is the fourth step? Fourth step is allocating, right? Allocating the transaction price to transaction price to performance obligations. Allocating the transaction price to performance obligations. Next one, what is that? Final one, that is recognize revenue when performance obligations fulfilled, right? Make sure. So I will be putting boxes here. So this is the first step. And this is the second step, right? This is the first step. This is the second step. This is the first one. This is the second one. First step in the para 9th. Second one in the para 22nd. In para 22, this is in. Then the third one. Third one, that is in para 47. Right? So this is the fourth step. And that is in para 73. Then the fifth step, that is in the para 31. So someone may ask why this is in 31. So that is how normally in standard. So there are some, first they tell about this, then come to like that. So that's why I told you should have a understanding of how to read standards, right? So these are the 5 steps. Right? So identify the contract, performance obligation, determine the price, allocate the price, then the recognize revenue when performance obligations are fulfilled or satisfied, right? Or performance obligations, let's say satisfied, not fulfilled, let's say satisfied. When performance obligations satisfied, right? I'm just telling you what is exactly in the standard. So no need to go through, no need to any translation like I did single medium one. So you can see in the channel, I did the same in single medium. So when I was doing the single medium, most of the English medium students asked to do that in English medium too, right? So that's why I'm doing this, right? So I hope anyway you had already followed your A-level accounting lecturers, your school teachers. So they are very good teachers. And unlike past, right? So in previously when we were doing A-level, so English medium, very few lecturers were there. But currently I hope there are many talented, many good A-level lecturers are there. So I hope you are attending one of them. So make sure from this lesson you will refresh your knowledge, but you need to do more question. So better you revise and better you get the help of your accounting sir and maybe the school teachers as well, right? So when identifying the contract, Lamai, what is identifying a contract? A contract could be identified. A contract could be started in three ways. In three ways. First one, a contract can happen either in a written format, right? Either orally or either implied, just implied, implicate, right? Impliedly. What is that? Written means you just write in a document, right? You sign and you have a contract. Orally means you talk with them, okay, agree, done. Or other ones, imply. You just imply to the other person that you should have a contract. So it's like you are going to the shop, you are having the phone in your hand, so you cannot tell to the Mudalali. So what you are doing? You show that to the Mudalali, I need this. So Mudalali is giving. So that is from your expressions. So then also you can have a contract. Okay. So then, Lamai, to identify a contract, there are following criteria to be fulfilled. So maybe for a theory question they can ask. So what are the criteria? So see, this is in the para 9, right? See, this is in the standard. See, para 9, identifying the contract. See, A, B, C, D, E, everything is there, right? So what you learn is what is in the standard. Okay. So what's the first one? It says parties to the contract have approved the contract. Parties to the contract should approve the contract, right? Parties to the contract should approve. So either written, verbally or implied. Second criteria. What is that? That is, entity can identify each party's rights regarding the goods or services to be transferred, right? Should have to identify each party's rights. Each party's rights you should be able to identify. Then entity can identify the payment terms, for the goods or services to be transferred. Identify the payment terms to the goods or services to be transferred. Next one, contract should have a commercial substance. Contract should have a commercial substance. Commercially it should be viable. Right? And also there is a probability to collect the consideration. Probability to collect the consideration. Consideration means for this they are paying something, no? So that should be collected. So when all these 5 criteria are met, you can identify the contract. These 5 criteria should be met, but in the examination context, I don't think they will test like that. But maybe for a theory question in MCQs, they could test, let's say, what is not a criteria in the contract, something like that. Then the second one, Identifying the performance obligations. Identify the performance obligation. Lamai. What is this? When you deliver something, Lamai, in that delivery or in that task, there are some deliveries, performance obligations are embedded in the package, right? So here, wait, I will go to the standard and read. Right, so it says the customer should have to receive the benefit and that benefit should be differentiate from the other performance obligations, right? Customer should receive a benefit and that benefit could be distinct. This is the word, distinct from others. I mean, you have to have a way to separate. So as an example, I'm just giving you example. Let's say the classes at online accounting, right? Let's say the classes at online accounting. So after A levels, you are coming to online accounting to do either chartered, right? So that is the first recommendation from me. If you want to select something, just go with the chartered. People will say different thing, but you have to see how the output people are there, right? The chartered accountants, what they are doing currently, right? What is the output you have to see. Maybe you come for the AAT, maybe some students are there who are doing AAT final, right? So AAT first and second level done before the exam. Some are waiting to do AAT final after the exam. So maybe you are coming for AAT final to online accounting. Maybe you are coming for CMA, Certified Management Accounting. Maybe you are coming for ACCA, right? Association of Certified Chartered Accountants. So that is not Sri Lankan chartered, right? That is also not a chartered accountant. If you get the ACCA, you are not a chartered accountant, but you are a professional accountant, right? So either chartered or ACCA I would recommend, but chartered in bit of higher. But if not, the second option, you can go with the ACCA. So that is also available at onlineaccounting.lk. So let's say when you come for that Lamai, normally in our course offering, we deliver different performance obligations to students. What are these? We tell to students that we cover, right, full syllabus. We tell full syllabus coverage will be there. So syllabus coverage is a performance obligation or not? It's a performance obligation. Why? Because customer is receiving the benefit. And also syllabus coverage could be differentiated from the other benefits as well. Right? Then we give tuts. Right? We give tuts. We give tuts for the related content. So that is can be distinct. I mean, can you separately recognize tut? Tut එක මෙහෙම recognize කරන්න පුළුවන් බලන්න. You can see, no? Tut you can see. So differentiate, you can do the differentiation from the full syllabus coverage. That is one, and you are having a tut. So that is another performance obligation. And once this is done, we will be doing the paper discussions. Right? So basically the first levels are MCQs. So mainly the chartered, right? The pass rate also like very high. because MCQs, right? So paper discussions, you are having paper discussion. So that is also we deliver separately. I mean, we are covering the syllabus. Again, we do the paper discussion from top to bottom. One selecting one paper and doing that. Then at the last we do live sessions. That is the quick wrap up, right? Maybe let's say recap, quick recap. We do live sessions, that is not beginning, that is like before 1 month or before 3 to 2 weeks to the exam. So normally we put in videos, just like you are watching this video in website, we are putting the videos in our website. Sorry, you are seeing the videos through the YouTube, so we are putting the videos to the website, right? And even you are having MCQ question in our website. So Lamai, what I want to make sure, what I want to emphasize is, in our course offering, we divide the course offering into few parts, and these are what? Lamai, these are the performance obligations. From these you will receive a benefit, and also you can differentiate each of the performance obligation. Now there are some performance obligation that you cannot differentiate. What is that? If you go for a physical class, right? When the lecturer is delivering the lecturing and the physical place, can you differentiate? No. The physical place you are not getting separately. The lecture delivery and the physical place both happening at the same time. So in that case, that is not a distinct performance obligation. So distinct performance obligation means in one contract there are different performance obligations or different promises that you agree to give to the customer. So you need to first separate those performance obligations, right? That is the second step. Then the third step. What is the third step? That is Lamai. Then you have to determine the total price of the contract. So that could be either, so this is in the 47th para. Okay, so that is basically in the price you could have variable price, right? You could have variable price, so including discounts, right? Discounts, incentives, you can put anything. And also there are financial consideration, financial component such as interest. You may get the price in different ways. Some people pay, let's say like Singer Abbas, they give you some goods and they get a interest also when you pay in installment wise. Then there are non-cash consideration as well. Non-cash consideration, I mean these are not that much important Lamai, but just to make sure for the theory question, right? But what is important is the fourth and the fifth one. So fourth one, you have already determined the price, but now you need to allocate the price into the performance obligations. How to do that? I will do this with an example. Right? Example. So what is the example? Example is, Lamai, now you are having a laptop shop near to you. You are having a laptop shop. You go to the laptop shop, laptop Ayya, you are asking Ayya, how much is this laptop? He says, laptop is 100,000 Nangi. Laptop is 100,000, right? Laptop is 100,000. Then you ask, what about the internet connection? He says, internet connection is 20,000. Internet connection is 20,000. And there is a board that they are servicing the laptops also after some time. So you ask, what about the service fee cost? He says, service fee cost is 5,000. So now you are calculating. Laptop is 100,000, internet is 20,000, service is 5,000, right? And the laptop buyer is telling now, if you get the laptop and the internet both, I will give you that for an amount of 110,000 and also I will give you the pre-service. This poor girl doesn't know that a service will be coming with the warranty. So she thinks that this ayah is telling her truth, right? So what is happening? Now you are going to purchase that. But the thing is, you are going to purchase this from your tata's company's money. So your tata, your daddy is asking how to recognize this in our company. Now you need to give advices. So what is the example? What is the example? Buy a laptop and internet package for 110,000 and also service will be free. Service will be free to you, right? So what you have to do, Lamai, now this 110,000 is if you purchase with a package, no? If you purchase everything together, make sure always when you are allocating the price into the different performance obligations, you need to first look at what was the cost before this bundle. What was the cost if I buy these separately? So as you ask from the laptop buyer, right? So that is, laptop is, right? Laptop is how much? Laptop is 100,000. Laptop is 100,000. Then the internet package is 20,000. Service is 5,000. See, if you separately purchased all these, that is Lamai 125,000. But when you take everything together, right, as one bundle, that is 110,000, right? So now you have to advise your tata on how to recognize this, right? How to recognize this? Just see carefully. Lamai, since you are getting service at a free, you cannot tell service is free, right? You cannot tell service in a free. So let's say your tata getting, but that is the revenue is not for your company, right? Revenue is for the laptop person, right? So your tata is just asking, let's say, how this person should recognize this revenue. So you may tell, no tata, this was given for free to me. So maybe they are not recognizing that. No. What you have to do is, Lamai, when you get the 125,000 equipment for 110,000, there is a total discount of 15,000. So make sure, Lamai, this 15,000 discount, you have to divide in all these three. How? Equally? No. Then how to do that? Make sure first you need to get the total value. Total value is 110,000. 110,000. Lamai, that is divided by the total value before having the discount, which is 125,000. 125,000. That into this previous price of each item. So this is by 110,000 into 125,000 into 100,000. That is 88,000. 88,000. Next one, 110, 125,000. This is 20,000. So into 20,000, that is how much? That is 17,600. The last one, 110,000 divided by 125,000 into 5,000. That is how much? That is 4,400. 4,400. So then, now you know how to allocate the revenue. So what we have done actually, we got the previous price. So as per that weightage, for that weightage, we have divided this price as well. So what is actually happened? This 15,000 discount already allocated to these three based on the previous price. We tell this as based on the standalone price. That is in the standard. Standard says allocate the transaction price based on the standalone price. Right? Standalone. Right? So once we do the calculation, we got this. So for laptop, we need to recognize laptop and internet, then service. So laptop at 88,000, internet as 17,600, then service at 4,400. So total is 110,000, right? That is the fourth step. Then Lamai, fifth step, the last step. Last step says you have to recognize the revenue when performance obligation satisfied. Lamai, performance obligation could be satisfied in two ways. Two ways. First one is at a point in time. Second one is over time. Point in time and over time. Point in time and over time. So what is point in time? Point in time means normally Lamai, this is for goods, right? Normally this is a good. This is for goods transferring. Normally this is for goods transferring normally, right? Goods transferring, and when goods transferring, if the control of the good transferred, then you need to recognize the revenue. If the control of the good transferred, you have to recognize the revenue. Make sure this. What it says here, you should be able to receive the benefit, which is the customer, receive the benefit and avoid others to get benefits. Receive the benefits or avoid other to get benefit. Avoid other to get benefits, right? So let's say just example. Lama, you are going to the shop. Mudalali asking an egg for you. Egg bitteraya killana. Right? You are getting an egg from Mudalali. You are asking Mudalali, I need an egg, give me. So Mudalali is giving you an egg. When Mudalali is giving you the egg, right? Just before he is putting the egg to your hand, right? It got damaged, right? And you couldn't use the egg for further, I mean maybe omelette or something for that, you couldn't use. Why? That is got damaged, right? Vitare kadila meya veno, right? Broken. Egg broken. It was broken. So now, can Mudalali tell, give me money because your egg is broken? Can he tell? No. Why? Because you are telling Mudalali, I didn't get you egg, no. Just when you put the egg only that happened. So, the risk, the control is with you. Which means what, Lamai? Which means still the control is with the Mudalali. So, Mudalali didn't give the egg to you. So, when giving the egg, before transferring the control to you, something broken. So, when that is broken, the risk also to the Mudalali, and if there is a benefit, maybe since that is broken, so there is a golden chicken coming out of the egg. Golden hen, right? Coming from the egg. So that benefit is to the Mudalali or to you. Can you now tell, nah, Mudalali, this is my egg? No. Mudalali will tell, no, Lamaya, this incident happened before I am giving that to your hand. So the control is with me. So if there is a risk or return, that is also to me. But other way around, Mudalali gave to you, you got that. And because of your, let's say, carelessness, egg broken. So the risk also to you, benefit also to you. Why? Because Lamai, control transferred. Make sure in this standard, we don't consider whether the cash received or not. So if the cash also not received, but the control passed to the customer, you have to recognize. You have to recognize. So let's say as an example, you are having your business, customer is sending a lorry. Customer is sending a lorry to collect the goods. So once you deliver the goods to the customer's lorry, your control is done. So in that time, you need to recognize revenue. Whenever you put the goods to the customer, at that time you need to recognize the revenue, right? Because that is where the control transferred to the customer. So make sure you recognize the revenue in a point in time when goods transferred, that is at the control, when the control transfer. The next one is overtime. So here you should have to receive the benefit, and also you should have a right to avoid others to get benefit from the same. Get benefit from the same good, right? So then overtime. In overtime you could recognize in like following three circumstances. What are them? First one, right? First one, if the customer receives and consumes the benefit at the same time. So let's say you are going to meet a doctor. So doctor is giving you the service. At the same time, are you consuming the service or not? You are consuming. Can you say, doctor, I will save this and I will send to someone? No. You are going to film hall. You pay to the film is screening. That is the customer receiving the benefit now. Are you consuming now? Yes. Can you keep and watch later at the film store, film hall? No. But in a good you can do that. You buy, you consume later like bit potakano. But that is not happen in the service mostly. Mostly, like not all. So make sure if you are receiving the benefit and consume the benefit at the same time, it should be recognized with the overtime. So overtime can mokada lamai. So this is based on the percentage of completion. If it is 50% done, from the total sales value, you recognize 50%. If 70% done, from the total sales you recognize 70%. So likewise you need to recognize. Next one is businesses with WIP, businesses with work in progress, you will recognize over time, right? You will recognize over time. Then, if you have a right to pay, if the customer is having a right to pay for the finished work up to now, so which means the work not finished yet, but customer can pay for like 25% of the finished can pay. So likewise if you can pay, so then also you will recognize over time. So make sure if it is a point in time you recognize everything at once, but when the control transfer. If it is over time, you are not recognizing everything at once, but over the time like a percentage you recognize. So that can happen, that can be happen only in these three circumstances. So if that is there, you have to recognize it over time. So make sure cash is not a major thing here. What you need to looking at here, the control. In sometime the company account question, the examiner could tell you the, let's say goods are there, goods already transferred but not cash received, but that is a revenue. Sometimes examiner could tell you cash received but goods not transferred, so that is not a revenue, right? So that is like a advance income received, right? So make sure SLFRS 15, there are 5 steps and you have to know all these, because sometimes even theory question can be asked in the first paper. So with this SLFRS 15 also done, right? SLFRS 15 also done. So the next one, that is SLFRS 16 leases. SLFRS 16 leases, right? Lamai, what is a lease? I hope you all heard what is mean by lease, right? Lease means what? Just a small example. Let's say you are there, right? You are there, and you are going to get a Toyota car, right? Just after qualifying as a chartered accountant. So let's say at the final stage of the chartered, you are getting a vehicle, you are going to get a vehicle, right? Without parents' money, from your own money, right? Whatever you earn from that, you are going to get a vehicle. So this is from Toyota company, right? But the thing is, Lama, you don't have initial money to invest for this. So what you will be doing? You will be asking from a bank whether can you give some money as a loan to me? So I will put the initial, you give the rest, right? So that person we call as the financial institution, right? The financial institution, that is the lessor. That is the lessor. So you are the lessee, right? You are the lessee, right? You are the lessee. Sorry. You are the lessee. This is the lessor. So this is the financial institution. So what they will do, Lamai? They will get this vehicle. They will pay the full money to them. And they will allow you to use this vehicle, but monthly you pay installments to them. So actually who is the real owner of the vehicle? That is the bank or the financial institution. That is the lessor, right? That is the lessor. So you are the lessee, you are the one who is taking the lease. He is the one, the company is the one who is giving the lease. So they are the one who is owning. If you go to Sri Lanka, 75% of the vehicle in the roads, that is owned by either banks or financial institution. People just write like they are, but legally that is not owned by them. But Lamai, who is using the vehicle? This person or you. Who is maintaining this person? Who is modifying this person? Who is doing everything for this vehicle? That is this person. So when this person is doing all of these, in reality, actually who is controlling the vehicle? That is you. So because of that, standard says, even though you don't have the legal ownership, but you have to recognize that in your financial position, that in your company as an asset. But not as a property plant equipment, not as PPE, but as a separate asset called what? Right of use asset. So you have to recognize, but not as vehicle, not as property plant equipment, but as right of use asset. So that is how this lease standard is teaching you, right? So I hope the initial understanding of the lease is okay, right? So we'll go for the measurement. So in the measurement, lamai, I divide the measurement also like previously into two. What are them? First one, initial measurement. Right? Initial measurement and subsequent measurement. Initial measurement and subsequent measurement, right? So this is in the para 22, this is in the para 29. So Lamai, initially or subsequently, always you have what? Always you have to record two things. What is that? That is, you have to record two things always. That is right of use asset. Right of use asset and lease creditor. And here also right of use asset, lease creditor. I'm doing exactly the same of the singular video, but I hope the duration would be lesser than that, because very easy to teach in English, and also since the translations are not there, that is easy. But I am doing this after the singular video, right? If you cannot understand, you may go, but I hope you can understand, right? So then make sure the right of use asset Lamai, that is the right, and also there is a liability. The right of use asset you have to always recognize at cost. Always recognize at cost. Initially at cost. So what should be included? for this cost? What are the things that is included for the cost? That is the, wait, I will go to the standard. That is, the cost of the right of use asset shall comprise. So that is in the 24th para. This is initial measurement, 22nd. I am not putting that. Right? So that is initial payment. Initial payment. When you buy a vehicle, normally you have to pay an initial payment. So if your father or mother is having a vehicle, just go and ask whether you got this from lease. Just start the process just to know practically, right? So then other direct cost lamai. So there are some direct costs when you have the vehicle. So you need to pay to the banks the direct cost. And also future present value of future installments. Present value of future installments, right? Then the final one, that is the same thing I told in LKAS 36, LKAS 16, dismantling costs. Dismantling cost, that is also the present value, right? So just ignore this. Initial, not the initial measurement, initial payment. Initial payment, direct cost, and present value of the future installment, whatever you pay. So which means the initial payment, and also if there are any other costs, and also the future payments, that is being present value to this, right? So then the lease creditors, lamai lease creditors, nothing you have to put, just this one, present value of future installments. So this is what you need to recognize in lease creditor. That is initially. So when it's come for the subsequently, what is happening? Subsequently you have actually three methods that we call cost model, then fair value model or revaluation model. So basically in your syllabus it is like two, but there are three, so you can tell as cost or revaluation model. So if it is a cost, what are you going to depreciate this? Yes, you will depreciate this as well. So if it is a cost model, same like the cost minus the depreciation carrying value you have to put. But that is not in the PP note, that is a different note for the right of use asset. Then the lease creditor, subsequently, how to recognize that? Initial liability. You should have the initial liability. For that, you plus the interest, then you minus the installment payment paid. So whatever remaining, that is what you need to put in the lease creditor, right? So in lease creditor, initially I know this is not still understood, but I have to show this in a ledger accounts, right? So don't worry. So lease creditor, initially the total future installment, but in future you pay something and there is a interest also will be adding, so you have to recognize that. So this is how you are recognizing. So I will just explain this with the ledger accounts and also with the double entries. So I will have the two accounts. right of use asset, right of use assets, then lease creditors, right of use assets, then lease creditors, right? Lease creditors, right of use assets and lease creditors. So these are the two accounts. Okay. So first one lamai, first one, initial payment. So you are having initial payment. So when you pay initially, how to recognize? When you pay initially, you have to recognize. So you pay cash credit and right of use asset debit. Cash credit, right of use asset debit, right? Okay. So then the lease creditor, right? Or let's say lease liability. I would say lease liability. Lease liability, that is right of use asset debit, lease creditor credit, right? So initially, right of the, that's what I told, initial payment cost and the liability, right? Next one is lease interest. So for lease, when you get the loan, you will be having an interest lamai. For the loan, you have to, bank is not giving you a loan, nikang denne, you have to pay an interest. So how to record the interest? That is interest expense or P&L debit, then lease creditor, credit, right? So this is debit, this is credit. So just put this. So let's say this is cash. First one, see, cash credit, right of use asset debit. So that you put here. Lease liability, so this is lease creditor, credit, right of use asset debit, right? Okay. So then there is a lease interest. So what you have to do? So here, see, right of use asset, that is debit, lease creditor, credit. So interest expense debit, so this is credit. So interest expense debit, this is credit. Interest expense debit, this is credit. Okay. So then when you pay installment, now you pay money. Lamai, when you pay money, what is happening? Cash credit, what is debit? Debit is lease creditors. You are having a liability. Your liability will increase with the interest, but again your liability will decrease when you pay, right? So this is cash credit, lease creditors debit, right? Okay, done. Then depreciation. Is it not about recognizing these, but there is a depreciation as well, right? So you can depreciate, so that is depreciation expense account, debit, accumulated depreciation, credit, right? And then once this is balanced, you are having a balance brought forward amount that is being get into the next period as well. And here always this is the value, right? So this value will be again balance brought forward, but make sure from the accumulated depreciation account, whatever the depreciation you need to deduct when you are showing in the financial position, right? This is how that is happening. And make sure, Lamai, now you might be thinking, now sir, we are putting cash here, the initial payment and the lease creditor. So how come the cost of the asset will be equal to that? So let's say you are buying a vehicle for 50, so 5 million, for 5 million. So which means that this should be the cost, this should be 5 million. But how can it could be 5 million? Just think the whole vehicle you got from a loan, the total 100% funded by the bank. That is not normally happening. So 5 million will the bank is giving you free, not free. Bank is getting a interest. So if you get 5 million, you have to pay more than 5 million Lamai to the bank. So let's say the interest rate is 10%. So let's say this is only 1 year. So how much you need to pay to the bank actually? So that is 1.1, which is equal to 5.5 million. Now, if you pay bank to 5.5 million, so how come you recognize 5 million here? This says the present value of the lease creditor. Lamai, how to get the present value? That is 5.5 million divided by 1.1 to the power 1. This 1 means, 0.1 means the rate. 10% into the power 1, you just do this calculation and see the answer is 5 million. So that is what I say, present value of the lease creditor, what you put here, the total will be equal to cost. So that's why here this is with the interest, but when you present value, interest portion will be removed. And the net one only will be having here. So that's why you put here 5 million, but the next year, you put interest as 500,000, and when you pay the payment, so that is being set off. That is what normally happens, right? So that is how happening. And also make sure when you depreciate, Lamai, make sure first you need to look at whether the asset ownership transfers or not. If the ownership transfers, no problem, then use the useful life of the asset. If the ownership not transferred, then useful life or lease term, whichever is lower. Which means to depreciate, if you want to depreciate, first you have to look at whether the asset ownership transfers. If nothing given, you have to assume that is transferred. Normally this one is tested. So if the transferred, that is you can depreciate for the useful life. But if it is not transferred, then useful life or the lease term, whichever is lower, you have to depreciate. So that is Lamai, end of the SLFRS 15, right? That is the end of SLFRS 15. Then Next we are going for LKAS 37. Next one, that is a long name, LKAS 37 provisions, right? So normally warranties coming from this provisions, contingent liabilities and contingent assets. Provision, contingent liabilities and contingent assets. Okay. So first one is the provision. First we are going to learn, that is provision. Okay. First one is, that is provision. Yeah, I put it. Provisions. Lamai, what is a provision? What is a provision? Provision is telling us a liability of uncertain timing or amount. See, provision is a liability. Provision is liability and it is an uncertain amount or time. This is very important. This is very important. Right? Now before that, before going for this one, just clarify what is meant by a liability. Liability is what? Liability means you should have a present obligation. How you can have a present obligation? Lamai, present obligation can happen either a legal obligation or a constructive obligation. Present obligation can happen either with a legal obligation or a, it could be a legal obligation or a constructive obligation. It could be either legal obligation or a constructive obligation, right? Make sure. It could be a legal obligation or a constructive obligation. What is a legal obligation? Lama, legal obligation is legally. So let's say you are having contract, so that's legal. So income tax department is telling to pay taxes according to the act, that is a legal obligation. So what is constructive obligation? Constructive obligation means that is not coming from an act, but that is just like a tradition. So when you go to a petrol shed, you expect the person in the petrol shed is putting the fuel to your vehicle, putting petrol to your vehicle. In other countries, is that happening? No. In other countries, you have to put. But in our country, we think that is should be done from their self. So that is an obligation, but not from legal. That is a constructive obligation. So we are having a norm, like a matayak wage kind of opinion that, okay, this should be done like that. So that is a constructive obligation. So because of these two, there could be obligation, but so when you have that kind of obligation, that is a liability can happen, but my provision will happen if there is a liability, but if the amount or time is uncertain. Uncertain, what is that? Amount or time. which means only one to be uncertain is enough, which means we don't know when it will happen. And even if that happens, we don't know the amount. So normally this is for a warranty, no lamai. Warranty, we don't know when that will happen. When the warranty person will come after damaging their equipment, we don't know when will happen. And even that if it happens, we don't know what is the amount. So anyway, we know that there is a liability. We know that it could happen. So if it happens, yeah, we have a liability. If that happens, we are having a present obligation. Right? If that happens, we are definitely having a present obligation. But we don't know when it will happen, or if it happens, what is the amount? What should be the cost that we need to bear? So that is we call uncertain amount or time. So let's say if this is not uncertain, that is what? That is not a provision, that is a liability, just a liability. Right? So make sure to be recognized as a provision, it could be a uncertain amount or time. Uncertain amount or time. So what you have to do here, so if it is a provision, what you have to do, so you have to recognize in profit or loss, and also provision account. So provision expense, warranty expense debit, provision account credit. That is how you have to recognize, right? And make sure here to recognize this, you should have to fulfill 3 criteria, Lamai. 3 criteria. What is that? 3 criteria is present obligation should be there. Present obligation due to a past event. So what is the past event? If it is a warranty, we sold the good. So due to we sold the good, there is a present obligation. And resources will go out when settling the liability. And also if the value can be measured reliably. So if you have a present obligation and the resource will go when settling, and if the value can be measured reliably, then you can recognize this provision. Then the second one, that is a contingent liability. So contingent liability is what, Lamai? Contingent liability is a possible obligation. That is a possible obligation, not a current present obligation. Possible obligation, and it's a possible obligation, and that could arise from a past event, and the existence of the obligation will be confirmed only by the occurrence or non-occurrence of uncertain future events. What is that? Lamai, currently you don't have obligation. obligation is possible, but whether the obligation is happening or not will be decided based on the future activity. Example is a customer is putting a LKAS, right? So still you don't have obligation, but obligation is possible if what happened? If you lost the court case. So it will be decided in future, right? So that is the first one. That is the first one, right? So this one is the first one. Second one. Second one, you should have a possible obligation, right? You should have a possible obligation, but from these three criteria, the last two, either resource will go out or reliable measurement cannot be done. So if this happen, right? So possible obligation is there, but either resource will go out when settling, that is not happening, or value you cannot measure reliably. So in that case also this is a contingent liability. Lama, if it is a contingent liability, how to recognize? We don't recognize, but disclose. Make sure we don't recognize, but we disclose, right? So the next one, so this is provision in the 14th para, contingent liability in the 27th para, and the third one, that is contingent assets. So that is also other way round, that is possible asset, right? That is a possible asset. So let's say we put a LKAS, possible assets and existence will be decided by the occurrence or non-occurrence of uncertain future events, the same thing, right? So if that is also happening, what you need to do? You need to disclose only. You are not recognized. So make sure contingent liability, other way around, is the contingent asset. So if you have a provision, so that is mostly the warranty or something like that, you have to recognize, right? So these are the criteria, okay? And if it is a contingent liability, it is still not an obligation, but it could be obligation based on what will be happening in future, right? So then, Lamai, we are done with LKAS 37 as well, right? LKAS 37 also we are done. So then we will be moving to LKAS 10. Lamai, next one, LKAS 10. Events after the reporting period. That is events after the reporting period, right? I will explain this like this. So let's say I will put like this. Okay, this and this and this. Lamai, this is the 1st April. This is the March 31st. So this period we tell as what? This is the accounting period, right? Accounting period. This is the accounting period. And this is what? This we call as reporting date. reporting date. So this is where you even make the financial position, right? Make financial position. Now Lamai, so this is what? So let's say I would put the date 5 May 30th. So this is the date the directors, let's say when you become a chartered accountant, you become a director. Directors approving date. Directors approving date of financial statements. So once you become a chartered accountant, you become a director, so you approve. Right? So what we call this period? This period, the period after the reporting period. And Lamai, make sure there are some events, that can happen in this period. There are events that can happen in this period, and we call them what? We call them what? We call them as events after the reporting period. Events after the reporting period. See, this is the accounting period and the events happen between the reporting period and the director's approving date. So after that, that is not event after the reporting period. So the whatever that happens in this period, we call as events after the reporting period, right? Now, Lamai, we divide this into two. We divide this into two. What is that? First one is adjusting events, and the second one is non-adjusting events. Second one is non-adjusting events, right? So you have events, adjusting events, non-adjusting events. What are the adjusting events? Listen carefully. Lamai, adjusting events means the events already happened, but we didn't know. Events already happened at the reporting date, but we didn't know, but we are getting the evidences only in this period, right? Only in this period, okay? So this means what? This means events which are providing evidences as to confirming those already happened on the reporting date, right? So which means already these happened, but we are getting evidences now, right? What is that? Tell me some examples. Tell me some examples. A customer bankrupted, right? But got to know after that. So that is basically bad debts. But the thing is, this customer bankrupted on this days, but we got to know only here. So customer bankrupted, a customer which was there at the reporting date bankrupted. So actually he was banked before that, but we only got to know after that, right? So then NRV of the inventory was lower than cost at the reporting date. So how to get that? So let's say at the reporting date the inventory value is 1 million. But when we are selling after 1 week or 2 weeks only, we realize we cannot sell that to 1 million. So which means actually at that date also that value is lower than the cost. Actually that value, the NRV is lower than the cost. But we didn't know. But we got the evidences only after that, right? So that is also a adjusting event. And also court decision of an ongoing case as at reporting date confirmed after the 31st March, right? After 31st March, after the reporting date. So when there are adjusting events, Lamai, what you need to do? You need to adjust in financial statements. If that is adjusting events, you need to adjust in financial statement. If it is non-adjusting events, what you have to do? If it is non-adjusting events, means events which provide evidences confirming those not happened on the reporting date. So they are not giving evidences, right? Which let's say which don't provide evidence, right? Which events which are not providing evidences confirming that which was not happened, right? So not providing, so which means no evidences. What are them? So let's say inventory destroyed by fire after reporting date. Which means Lamai, as at this date inventory was there, but it was destroyed due to a fire here, right? Inventory destroyed due to fire after the reporting date. So here due to a fire it was destroyed, but it was there here, but actually destroyed after that. So that is not going to adjust, right? And also announce dividends, right? Dividend announcement, that is also not non-adjusting event. So non-adjusting event, what we do? We don't adjust, but we disclose. We don't adjust, we do not adjust, but we disclose this, right? Don't adjust but disclose. So that is the Lamai end of LKAS 10. So make sure in your company question there can be adjusting event and non-adjusting event. Make sure clearly differentiate, and if it is adjusting, just adjust. If it is not adjusting, just disclose. So LKAS 10 also we are done. So then next one is LKAS 8. So next one, that is LKAS 8. LKAS 8, right? accounting policies, changes in accounting estimates, and errors, right? Lamai, here, this is also you need to learn three things. First one, policies. I will just read what is mentioned in the standard as policies, right? Accounting policies are the specific principles, bases, conventions, rules, or practices applied by an entity in preparing and presenting financial statements, right? I will give you some examples, Lamai, for the policies. What are the policies? Selection of FIFO WAC method. Selection of FIFO WAC method is a policy. Next one. Selection of costo revaluation model as per LKAS 16. That is what? Lamai, that is also a policy. So policy is what? Policy is something that the company is selecting. So company is continuing with the years, right? Make sure now when these could change. When this could be changed? Can they change this? When this could be changed? It could be changed either if it is recommended, by a standard. Either it is recommended by a standard or if either or if it reflects more reliable information to the economic users of financial statements, right? So either if it is recommended from a standard, you have to change, and also if the financial information gives a more reliable information, so then also you could change. In other ways you are not going to change. And make sure if it is changing, Lama, if it is changing, it should change for past, present and future, right? And future. We tell this right? We tell this as retrospective application. We call this as the retrospective application. Retrospective application, right? We call this as retrospective application. If it is changed, we have to change that fast. So you have to adjust the return earnings also and present and also future. So that is policies. Next one, accounting estimates. Accounting estimates. Lamai, what are the accounting estimates? Accounting estimate changes. So accounting estimates, I will give you some example, then you can understand. Useful lifetime is an accounting estimate because that is a kind of an estimate. And provision is estimate. Provision, warranty, kind of warranty, that is estimate. And also yes, that's enough. Provision for bad debts. Provision for bad debts, that is an estimate, right? Estimate can change. If it is changed, you have to change that for, if it is changed, could be changed for present and future only. Present and future only. So you are not adjusting the past figures if you are changing accounting estimates, right? Right. So that is we called as prospective. From the prospective point of view, we do that, right? Okay. So then, next one, that is the final one. If it is a errors. So errors means what? It can be mathematical errors, right? Mathematically error, or right, mistakes. It could be a mistakes can happen, no, right? Or it could be a misrepresentation, right? So if these something lamai mema godak wadagat ne, that's I'm like quicking up, right? So if this is being adjusted, make sure you have to adjust the comparative figures also, right? What is that? Lama, in companies, when we present the financial statement, we present 2 years, right? So let's say this is 2024, so we provide 2023 also. So if something change, you need to change these figures and these figures both. I mean, not the last year accounts, but just the restate. Just the restatement should be done, right? So that is the errors. So with this, so this is bit of a small one. Maybe one MCQ can be asked. If not, no, nothing more in the second paper, right? So LKAS 8 also done. Then you have 2 more, LKAS 7 and LKAS 1. So next one, LKAS 7, that is cash statements, statement of cash flows. LKAS 7, statement of cash flows, right? Lamai, so even though this is a standard, so you should have to know the way of doing the calculation, but I'm here only doing the standard perspective only, right? So in cash flow statement, what we do? We represent the cash we received and cash we paid, just like a cash book, but different format, right? So in a Cash flow means cash inflows and the cash outflows. Lamai, make sure in cash flow statements, we divide the cash flows into three. That is, first one, operating activities. First one, operating activities. Then, investing activities. Then, finance activities. Right? Either operating activities or either investing activities, either financing activities. So what is operating activities? What the standard says? Operating activities are the principal revenue producing activities. Principal revenue producing activities. Principal revenue producing activities of the entity. Right? So which mean, examples give me principal revenue producing activities. Pay for inventories, right? Pay for inventories. Maybe receive cash from the debtors. Pay to creditors. That is kind of what? That is a principal revenue generating activities, right? Okay. Then investing activities, right? Investing activities is what? Investing activities are the activities acquisition and disposal of long-term assets. Acquisition and disposal. Okay, of long-term assets and other investments right? What are these? You buy a asset, you sell asset, you invest in a investment. So those are investing activities. Final one is the financing activities. That is what? Financing activities are the activities that result in changes in the size and composition of equity and borrowing. Result in change in size and composition. Change in size and composition of equity and borrowings. What is that? If it is changed the equity level or the borrowing levels due to this activity, Lamai, that is a financing activity. Examples, getting a loan, issue shares, issue debentures, that is financing activity. So when it's come for the cash flow statements, Lamai, cash flow statements can be prepared in two ways. Either direct method. So there is a question in the class flow in the second paper, right? Make sure. I have already explained in the first video. If you haven't got the first video, how to get the A pass within few days, within few months, you can watch that. So direct method is what? Direct method is normal way. You put the operating activities, investing activities and financing activities, then done. But in indirect method, what is happening? You start with profit before tax. You start with profit before tax and then you continue. But make sure what is different in both. What is different in both? Lamai, different in both is, the similarity in both is investing and financing activities are same in both of the direct and indirect method. So make sure identification of the activities are very important with related to the definitions. So once you are done, so you have to do the calculation. So this is basically, not covering from the standard. So basically cash flow statement, you need to know how to do the cash flow statement, right? Okay. So then LKAS 7 also done. So next one and the final one, very small one, that is LKAS 1, presentation of financial statement. Lamai. Here, this is a very small one. What is included in this standard? Right? Objective of financial statement included. What is the objective of financial statement? That is to give information to interested parties to take economic decisions. So that is the objective of the financial statement. So that is mentioned in this standard. And also it is given the components, right? So that is given components we'll say complete set of financial statements. It is given the complete set of financial statements. What are the complete set of financial statements? So that includes what? Lamai, that includes first one, statement of financial position. You know that, balance sheet. Second one, statement of profit or loss. And other comprehensive income. Next one, statement of changes in equity, right? Then statement of cash flows. What we have done last. So then notes, right? Notes, policies and all, and also comparative figures. So those are the complete set of financial statements as per LKAS 1. And also here there are some more concepts called, right? Those are not that much important, but you may heard in accounting, going concern, right? Accrual basis, then materiality, right? Current and non-current. So I forgot to tell, in SLFRS 16, Lamai, the lease creditor, the liability, you have to divide into current and non-current, right? So whatever the payment you will be paying in the next year without the interest, that is a current liability, and whatever the capital portion you will be paying after next year, that is the non-current liability, right? So those are mentioned here, right, Namai? So then LKAS 1 also done. So I have done 1, 2, 3, 4, 5, 6, 7, 8, 9 standards I have done. So I hope you will do well at your examination and also you can join to the Telegram group mentioned in the caption, and maybe we may meet someday if you are doing chartered or ACC or AT CMA with online accounting. So I hope you all the very best. Study well. Doesn't matter whether time is limited. Have a good plan and study well. Ready for it. Plan it. I mean, ready with a smart way, right? I mean, just don't work hard, work smart. Hope you all will get an A pass for A level accounting.